Alan, welcome to the show. Thanks for joining us.
Thanks so much for having me, Dion. It's great to be here.
Do you want to start by just telling us a little bit about your early days in business?
I think it's most important to understand at the beginning that I'm very old. I started my career such a long time ago. It took me a long time to finish a degree at university. At first, I thought I wanted to be a chiropractor like my dad, and eventually, after a bunch of misadventures, I finally found myself studying journalism. And when I graduated, went and worked in old school journalism where the newspapers were still printed with hot lead, and you could hear the presses make Broadway rumble in Sydney down at Fairfax. It's a very long time ago, and before the internet. Right? So my first job was in a PR agency, and we had a typing pool. It was like an episode of Mad Men. There were a room full of women who did all of the typing for all of the men who did all of the work. So that was a very odd experience. But right in that agency at that time, the company decided that they should replace the poor typists with personal computers. That most of the people working in the PR agency had trained as a journalist and could touch type, and there was no reason why they couldn't do their own word processing. So I put my hand up because I was a geek from an early age and said to the boss that I'd love to be the person who scopes out what we buy and how we connect it all together and make it work with a printer. So that was my first tech job. But I started freelancing for a computer magazine and then became the editor of the computer magazine. And then reporting on the tech industry made me fall in love with it. I wanted to work in a new generation of technology companies. So there were old companies like Intel and IBM that were traditional American corporations, except for the fact that they made technology products. But there were new generations of companies, and I wanted to work for one of those. And they were starting to refer to themselves as startups. I wanted to work for a startup. The only thing was Australia was much further away from Silicon Valley back then. And it's hard to appreciate just how far. But I had been back and forth quite a lot with the magazine that I worked for, because without any internet, without any World Wide Web to go look things up on, if you were the person in an organization like me, trying to decide what sort of computers the company should buy and put on everybody's desk, you had to go to a computer expo, which was a big exhibition space full of computer manufacturers, or you had to read a computer magazine. So those tech companies would pay the cost of journalists like me to go and report on the launch of a new tech product. While San Francisco was a long way away back then, I had been there sometimes as often as 3 times a month when I was working as an editor. And I knew those were the people I don't want to work for, but I didn't want to work in Silicon Valley. I wanted to stay in Australia. So I managed to blag myself into a job working for Microsoft in Australia on something that eventually became part of MSN, the Microsoft network. That was Microsoft's first foray into web services and content. But Microsoft obviously wasn't a true startup. So the first true startup I joined was Yahoo. I almost by accident fell into a role as Yahoo's first product person in the APAC region and led the product development team for Yahoo Australia and New Zealand initially, and then the rest of APAC. That gave me an opportunity to go through the whole crazy ride of the dot-com boom from 97 to when I started to 2002 when I left. Yahoo and everything else in startup land went way up and then way down and then back to some sort of survivable middle there. I came away with that with a lot of really helpful relationships, a lot of hard-won experiences, not all of them positive, and a little bit of my own capital. So for the next few years, me and sometimes with some other ex-Yahoo co-founders, we had a go at building our own startups. Some of those were successful, some of them less. But as I started to approach 40, I started to think, if I'm a startup founder, every startup I do, I can only do that one startup at a time. And each one of those take 3 to 5 years to really play out before I know whether it's been worth it or not. Let's say I want to be a startup founder until I'm 55. That really only gives me maybe at most another 10 shots at this. And do I think that I could get a successful return out of 10 startup ideas that I had? And I started to think the average return is more like 1 in 20. So I'd have to be twice as good as the other startup founders out there in Australia. And I didn't think that I was able to do that. So I started learning about angel investing. So around about 2010, I became an angel investor. And I've been investing with other angels, individually myself, sometimes in syndicates, sometimes through VC funds that manage my money for me, but gradually becoming a self-taught angel investor in Australia. And just because I happened to be there at the beginning of it all, probably one of the most experienced and most.
Take us through the dot-com boom and bust. What was it like being in the industry in that time, right at the coal face?
It was absolutely ludicrous. There are so many crazy stories. I hardly know where to begin, but we started Yahoo in Australia and New Zealand. Yahoo Inc. grew internationally by bundling up the Yahoo brand. This is what you're allowed to do and what you're not allowed to do in marketing the Yahoo brand and serving customers. Here's some software technology that we've used to build some Yahoo services for the US market. Here's some basics on how to get started with that software so you can localize a version of Yahoo for your geography. And then here's some sales targets, some advertising sales targets we want you to hit. You and a small team of other people go out and do that, and you've got like a couple of months to get that built and launched and earning revenue for the business. Yahoo kept challenging little teams to do this in so many countries around the world. When I joined, there were already 13 countries part of the network, and it just grew and grew. So it was a very startup experience. But another thing that happened at the same time was we were getting paid way below market rates for our work, but we were offered employee stock options. And I very clearly remember in those days, you signed an employment contract with an American company via courier, via FedEx. A little man in uniform came, knocked on your door, and handed you over some paperwork. You signed one copy, both copies, kept one, the other one back in the courier. So there was this lag time, right? Maybe 7 days to 14 days between the package arriving and the package getting back to the HR department at Yahoo and you were hired. In that 14-day period, let's say, the Yahoo stock price doubled. And I didn't know whether the offer I was going to receive by courier was going to reflect the pre-double or the post-double price. The reason why the price doubled is absolutely crazy. So the stock price was rising fast, and Yahoo decided that they would do a 2-for-1 stock split. So everybody who was holding a share was now holding 2 shares, and each of the 2 shares was worth half as much as before. And in the space of a week, the stock price doubled again. So it was back to the price it was before, and the valuation of the company doubled in 1 week. I was here waiting to see what my employee stock options might notionally be worth on paper, not knowing whether I was going to get the pre or the post price. They gave me the pre-price. It was still another 2 weeks before I was actually due to start work at Yahoo, and I was already worth twice as much without having done a day of work for the company. So all of that kind of compounded. And so the way that Yahoo's employee stock option plan worked was that vested in 1/4 of your total amount of employee stock options for every 12 months served. And so the first lot came up on my first anniversary. And I'd forgotten about it. I had a lot of other things to do. I was working 18 hours a day for a rapidly growing company. But I got a call from a broker at Bear Stearns with a New York accent saying, "Hey, Mr. Jones, we'll receive this paperwork from Yahoo for you. I'm going to be your point person here. If you want to exercise and sell some of the stock options, here's the number and here's your account number," that kind of thing. There wasn't even a password. You just needed to have your name and the account number with the broker. So when it was time for me to sell, I had to wait until the New York Exchange woke up, like 10, 11 p.m. at night, Sydney time. So I'd get on and ring this number and speak to a guy with a New York accent and say, "Here's my account number, my name, and I'd like to exercise and sell this many Yahoo stock options." And they go, "Okay, Mr. Jones, we'll take care of that." And then this was back in the day when phones were phones, right? So I had an answering machine at home, like everybody did. And so the phone would be quiet overnight, but I'd wake up in the morning and the message light would be flashing. I'd go and play the message, and I hear this guy in this Bronx accent say, "We've exercised and sold this many shares for you." And I thought, that's crazy. The next day I got a call from my local St. George Bank branch manager, where I had a regular everyday savings account and a check account. They said, "Mr. Jones, we're expecting a large transfer of foreign currency." And I thought, "Oh, yes, I still was." Yeah. And he said, "What do you want to do with that? It's all in US dollars. Did you want us to set up a foreign exchange account for that? Or did you want us to convert that to Aussie dollars for you?" I hadn't thought through any of that. I guess let's set up a US currency account for me. So they did that. And then I had to go into the bank branch to sign, because this is all pre-signature. So I went into my local branch, walked up to the shops, went into the bank branch, asked to speak to the manager. And I said to him, "Could you print me out a bank statement after all this is done?" And so I signed the paperwork that was waiting for both of us, and he signed it and didn't really look at it. And then he printed out the statement. And as he was handing me the statement, he saw it and he comes with this double take. So it was just a little bit more than $1 million Australian, and I was 32 years old.
Yeah.
But this was back when I was able to buy a house in the lower north shore of Sydney for $450,000. So my slightly more than $1 million could have bought me 2 houses. didn't see it at that time. So that was the process of me working for the company for 1 year.
Yeah.
And I had another 3/4 of that value still to go. So Yahoo employees who were receptionists, who were executive assistants, who were janitors, who worked in the kitchens, ended up becoming multimillionaires. And I think that's a little bit of distortion to the way that capitalism really should work. Obviously, it's way up the end of the bell curve in terms of value for somebody's employment, for their working hours. It's obviously nobody's usual experience, but I don't like to think that's the way that capitalism should work. I would like to see, I'm not a socialist by any means, but I would like to see something a little bit more rational than that. I like to print t-shirts, design and print t-shirts for fun. And one of them says, billionaires are a policy failure.
Yeah.
And that's a paraphrase of a quote from an advisor to Ocasio-Cortez in the US. And I agree with that. I now know a couple of Aussie billionaires who've done quite well out of tech startups. I'm not one of them, but I knew them from back when they were regular people like me. And not one of them set out to become a billionaire. They all set out to achieve a goal that they had for themselves in business, but wasn't to make themselves wealthy. The wealth that they've created is an unintended byproduct of creating a successful software company in most cases. And most of them would actually be really quite comfortable to not be a billionaire. The problems and the complexities and the challenges involved with just responsibly managing that much capital becomes a burden in itself. You end up with a team of 10 or 20 people helping you make sure that it doesn't get stolen or misallocated, and those people need to be managed. And then inevitably, too much of it gets spent on vanity in private jets and 200-meter long super yachts. And there's got to be better ways to invest that capital so that people don't go hungry, so that wars don't stretch on for too long, so that people are more able to live in a democratic society. So I still really do think that the billionaires are a policy failure. I am very grateful to all of the NASDAQ investors who bought my employee share options. They really changed my life for the better and my family and my close circle. But I don't think that should be what we set out to do when we get going on the startup journey.
When you started on that startup journey, going back a year before that, was that in your wildest dreams in terms of you've got those stock options, so there's some sort of equity style investment there in the business, so you're a part of that growth? What was your thoughts 12 months later when you suddenly have that much capital and the rest of it investing in the future? What does a 32-year-old think at that point?
I was living in a rental flat with my girlfriend.
Yep.
I had less than $5,000 and combined in my savings and my check account. And I had a pretty substantial car lease. I can't remember what the dollar figure was, but I had a little Peugeot 306. And I was living from paycheck to paycheck. I had no savings plan. I had no other investments. I come from a working class family. My parents were both the first people in their generations to graduate from high school and graduate from university. And so I just was a complete outsider in this world. Because most of the people who were involved in the startup industry in the very early days, we were all outsiders because sensible people wouldn't have taken the risks that we did.
Yeah.
None of us knew anything about what to do. All of us were media salespeople who were square pegs and round holes in the advertising agency industry, or were tech nerds who loved to code and talk to strangers on the internet, but didn't really have any commercial sense. Yeah. Designers who wanted a more flexible canvas to work on than just television ads and print ads. So we were all misfits to a degree. None of us had come from a life of privilege, and none of us knew anything about what to do. One of us in that small circle of people happened to know a guy who once had a housemate who was a financial advisor. He ended up becoming the financial advisor to about 6 of us. Amongst all the different financial advice adventures, we had to go and get a private ruling from the tax office around how our gains should be taxed, because this is back in the days when you got taxed when it was granted to you, not when you exercised and sold it. Yeah. And when it goes up from less than $1 million in value to $20 million in value.
Worth checking that, right? Yeah.
It's a big deal. So there were instances of excess. There were people who went out and bought supercars and took first-class travel around the world and checked out and became an author or a playwright or a painter or something. lots of crazy stories about that. Yeah, I had some small adventures, but nothing quite to that scale. I think one thing that changes is you do see a deeper level of a person in how they respond to unexpected wealth. It's almost like being thrown in an episode of one of those reality TV shows or something like that, where you see a more primal sort of
Yes.
underlying makeup of who that person really is. There's the surface which they're able to display to the world most of the time, and then there's this underlying bit that sometimes comes out in periods of extreme stress. And believe it or not, unexpectedly becoming wealthy, it does cause an unusual amount of stress.
Yeah, I think that's one of my observations with that type of thing, is it can magnify some of our best and worst traits in some ways too, right? It's that type
Yeah.
of thing. And I don't think it necessarily
Yeah.
changes people, but I think it can magnify some of your attributes for good
I
and bad.
think I know this opinion is not going to be popular with somebody in the financial advice industry, but I do think that a lot of wealth in the world, trying to direct it and control its future behavior is as challenging as trying to affect the tides. The tide comes in and the tide comes out, and once you have tide tables and accurate astronomy and computers and things, you can predict when the tide's going to get high and when it's going to be low. But way back, and when 1,000 years ago, people didn't really know. Like the linear came up and down twice a day, but they were a bit fuzzy as else. And I do think we all live in a world where our net worth can go up and down according to forces outside of our control. That's happening to us all right now. Some of us may not be aware of it yet, but it is already happening. And when you can make the best of plans, and then those best plans can be ruined by an external force. It sometimes makes people get irrationally cautious, and that, what's it called? Loss aversion, the cognitive bias of loss aversion.
Yep.
Sometimes paralyzes people. I won't do anything at all, or I'm just going to focus on not losing any of my money, which is a kind of prison. It's a kind of psychological, emotional prison in which you lie awake until 3 o'clock in the morning, worrying what might happen. I don't really understand how I got it. What might happen if I lost it all?
Yeah. It's funny. Sometimes I've seen that sort of with people when they're in business. So they've got a successful business they've built and had for years. They've got X amount of money, but they've got cash flow. And you see sometimes a mindset shift or an adjustment period, let's call it, when they sell that business. Because when you've got a business and it's growing, not that money's unlimited, but you can make more of it more easily because you're in business, you've got cash flow coming through, you can pay for things out of business, whatever it might be. But you've got this business which is worth whatever it might be worth. Once people sell it and they crystallize that, then they've got what they've got, especially if they're older and they're not going on to another venture. They've exited the business. This is their future for them and for their family. This is their legacy. People do take a bit of time to adjust to exactly that idea, because this is now, they understand this is all we have. Big or small, It's all we have. So it doesn't matter how much it is. But then the mindset changes a little bit. When it's the business and it's running and they understand that, often when it's the capital on the other side of the equation, that's not there. That's a little bit more foreign. So I totally get what you're saying in that regard. And it does affect people differently.
Yeah. I have a lot of friends who are advertising industry veterans, and the advertising industry has gone through enormous change in the last 20 years, thanks to everything that's happening with the internet and startups. And that industry has laid off a whole generation of senior account directors, creatives at all levels, planning, strategy. And I don't have the data, but I would be surprised if you're not actually a partner or an owner of a large advertising agency holding company. I'd be very surprised to find you still in a job. It's been that dramatic. And it seems that quite a few of those people have been able to take the savings or the finances that they have left to go and buy what they call a boring old business, like a regular, not growing much, but not really shrinking very much, pretty resilient to change business, and just be very grateful that now the pressure's not on them every week to be getting 3 new pitches out the door to try and beat their competitor on price. And this is just a product or a service that customers have always needed. I get most of my new work through word of mouth, through client referrals. All I have to do is make sure that I don't blow this business up, and I'll be fine until I hit retirement age. I think that's a really interesting other side to that, where you've got the person who started that business, and they're now thinking about, how do I exit from this, extract the value that I think I'm due so I can enjoy my retirement and my lifestyle with my children and my grandchildren. I'm not sure how I'm going to live. I'm going to need that money to last me till the end there. And so they're going through one side of the transaction, selling that boring old business. And then there's another generation of people coming who may never have owned a window tinting or a house cleaning or whatever kind of boring old business this is. And they're absolutely terrified that they don't know anything about running a business in this industry. And this is the last of the money that they have in order to make a transition from what they were doing before. I think it's a really interesting time. I see a lot of that going on right now.
It's funny, even the boring old businesses these days are probably less boring in some respects, because if you fast forward, and you'll have a view on this, I'm sure, with things like AI and automation, robotics, and those sorts of things, even the boring old businesses may not be so boring for long. The whole world in the next, I think, 5 and 10 years is going to change dramatically. What's your view on that type of thing in terms of the future? And then we'll come back to the present too, because I'm interested in where you're at now, the mentoring and the venture capital stuff that you do now as well. But where do you see the next 5 and 10 years?
Yeah, so those really big black swan events over decades after they occur, and we had one with the COVID pandemic. And if you've been to the pharmacist, or if you've been to a GP or a medical specialist or a hospital since the pandemic, you would have noticed some of those changes that were introduced so that the healthcare system could continue on through the pandemic are now going to be with us forever. And they'll remain with us forever because it's just a more cost-effective and efficient way to deliver healthcare. But there was no reason why we couldn't have done it before the pandemic. It's just that we needed to stop these large, complicated processes and organizations for long enough so that we could introduce a new way of doing things and then to restart them again. And nobody was really prepared to take the risk of that going badly until the pandemic happened, and they had no choice. So now we all get to benefit from the upside of a really negative black swan event. I think probably what we're going through right now with what the Trump administration is trying to do in reorganizing the way world trade works, this may well end up looking like a black swan event of that magnitude again. And I would expect to see for the next few decades after this an echo of change. Some of those changes will be immediate and obvious to everyone, like a new attitude to working from home. Other changes will be really quite dramatic, but much, much more subtle, and they'll play out over time. I think it was Burroughs, the author, who said bankruptcy happens slowly and then all at once. And I think most great changes in the world happen very slowly all at once. William Gibson, the science fiction author, also said the future is already here. It's just not very evenly distributed. So working in startups, we get to see where some of that future is already here. And most of the rest of us in the world aren't yet seeing those changes in the works, but they are coming very soon. So all of those boring businesses out there right now, some of them are still pre-digital. Many of them are still working with diaries and very simple systems when it comes to technology. I think we'll see in the next couple of years, almost all business processes in all sizes of business, right down to the individual self-employed contractor, entirely replaced by digital tools that are largely powered by AI assistants that will do a lot of the menial work for us. When I log into my cloud bookkeeping and accounting system at the moment, I'm still dismayed and surprised at how little change has been brought in, how little AI I see in the products that I still have to use every day. I still have to manually reconcile invoices and payments, and there's no longer any need for that, but it's coming. And if it's not coming from the company that I subscribe to at the moment, then it's going to come from a competitor, which will arise in that opportunity to service a need that the big incumbent hasn't been servicing. An opportunity there for someone buying an old boring business right now is to come in with some knowledge of those tools and just revamp the way that the company books client service calls, revamp the way the company manages a small fleet of tradespeople in vans that go out and see customers, revamp the way that we model future performance of our business and understand how much cash we should hold at call. I think there's some tremendous opportunities, but always at the cost of massive risk as well.
Do you think in terms of that next 5 and 10 years that do you think the market in general is overestimating, underestimating, or about right in terms of where it's projecting AI to be? I personally think that it's going to be the most significant invention's the wrong word, but technological advancement that we've ever seen. That's what I think the next 5 and 10 years hold, or 10 years. It might just be hyperbole. What's your thoughts?
Yeah, I think professionals and amateur investors alike struggle to cope with complexity and struggle to accurately forecast the future as a result of us all struggling to comprehend the true complexity of the systems that we're in. I know in the markets at the moment, retail investors and large institutional investors and even sovereign wealth funds, are very excited about the potential of companies like NVIDIA and OpenAI to radically change the world of software development and the software tools that we all use today. And to a degree, that is true. I'm fairly confident that both of those companies will be very valuable companies in the end. But at the moment, they're trading on an absolutely massive multiple of their actual revenue. And so that's obviously one end of a bell curve. In the middle of the bell curve, the majority of the value is going to come from people who are investing in companies that are worth $10 million today and might make it to $200 million before they're acquired by a larger company, or might make it to $500 million before they IPO or get bought out by private equity. I think the vast majority of change in the world that we're going to see and the vast majority of value for investors is going to come from those mid-rank technology companies that most retail investors and most analysts, even most journalists, don't really get to see, and they certainly don't really pay enough attention to.
Yeah, I think that's an interesting one. I think I was speaking more generally in terms of AI as a technology to change how we live in everyday life. But from an investment perspective, I think it's interesting because you've got, and you would have seen this through that sort of tech boom and bust in terms of and the way the internet impacted. I think it's not dissimilar. You've got companies at the forefront of it. You've got those medium-sized companies and smaller companies that will have a huge impact. But the flip side is then the more traditional businesses that adopt those technologies. You go back to the banks and the media. The banks, once upon a time, you had all the tellers and it was all very manual. Banks incorporated everything online and changed their entire businesses. In some respects, almost unrecognizable compared to what they were 30 years ago. So I think that type of change is coming too with AI.
Yeah, definitely. And it's mainly, it's not whether the technology is ready or whether the work can be changed to adapt to the AI. All of that is already in place. What limits the rate of change is mainly customer perception of the organization that undertakes the change too quickly. So the banking system was falling over itself to get rid of bank tellers, but it couldn't sack them all at once because that would look bad. It would damage their brand reputation. Government would be angry with them. Business would get harder for a while. There was very little upside to put in that story except for bank shareholders. So the rest of us didn't want to see that. So the banks had to take the time. It took them really 20, 25 years to get all the tellers out and replace them with technology. And so the same will be true of AI. It's certainly possible that in 5 years' time, we could replace a very large part of the white-collar workforce entirely with AI systems and people managing those systems to make sure that they perform correctly. But the limiting factor will probably be our ability to cope with that change and how that change makes us feel as a society, as governments, as an economy. Too great a rate of change scares the willies out of all of us.
Yeah, okay. That's interesting, right? Because that's very true and often disregarded or not given the weight that it probably deserves in terms of its impact. Is people are reluctant to change.
It's like holding back the tide. Yeah. You can divert it a bit, but you're not going to stop it. It's coming. Yeah.
What about in terms of what you do today? Do you want to tell us a little bit about the investment philosophy you've got and what sort of businesses you look for and what you look for in founders as well?
Yeah. Last year, I co-founded Angel Investor Syndicate, focusing on investing in tech startups, and we're called MATE Ventures. That's letter M, number 8, Ventures. And it reflects the investment thesis of myself and my venture partner, Emily Rich. We're both tech nerds. I think that's important to disclose, but also impossible to disguise. We're both scruffy tech nerds. Actually, she's not scruffy. I'm the scruffy one. She's a skilled and experienced software engineer. She built and sold a successful machine vision as a service startup. Some of its early customers were Facebook, Google, Coca-Cola, Pepsi. This is a pretty big thing for somebody who was in their late 20s. And my background as a product manager, leading teams of software engineers, designers, product people, we had a lot in common when we first met. And we were both curious about getting into venture investing. Our worldview and the things that we were interested in had powered our investment record as individual angel investors. As an angel investor, nobody's evaluating you other than yourself. Maybe your spouse or partner is concerned about what you're doing with everybody's money, and so maybe they want to have some oversight about what's going on, but you're not really accountable. And the way that you deal with difficult times is you just stop. Right? You just go, oh, I'm a bit worried about Trumpistan. I might just hold off on angel investing for the next 6 months and see how things go. Everything changes when you decide to become a professional investor. And for me, I decided to start along that journey about 10 years ago. And so now I make all of my living from investing in tech startups. And for some time, Emily had been doing that as well. So our investment thesis is focused on around the fact that if you're going to build a valuable technology company, you ought to set out to build world-class technology. It's difficult to find an example of a technology company which is hugely valuable, which isn't also world-class when it comes to building technology it builds. My favorite example is Apple, perhaps. There are some technology companies that used to be at the bleeding edge and who are still very valuable, but they're getting the corners of their empire chewed off by more innovative, better quality technology companies. So an example there might be Microsoft, for instance. This is still doing very well in many areas, but there are lots of little areas of this business that are getting hived off. So then I both care about building world-class technology products, and yet the skills and the experience to do that out of Australia and New Zealand, which is where we focus, are few and far between. We don't have a Stanford, we don't have an MIT, we don't graduate that many people with the skills required to build world-class technology products. And many of the people that we do want to go and get a job with Combank or Qantas because it means they'll be able to start saving for the first home with an income which is much more predictable than a startup income. So we think one of the interesting aspects of what we do is we're trying to find the scarcest resource in the startup industry, right? So if we were miners, we'd be trying to find those rare earths that are so valuable right now. So rather than being a bulk exporter of coal or iron ore, we're trying to look for those very, very valuable specialist materials. You need to be somebody who knows how to evaluate that kind of talent, and that's what we try and do. We don't have a sector focus. There are two sectors that we don't touch. We don't touch the defense industry because people die, and we don't touch the extraction industries because it's too difficult to invest in startups around that area without getting involved in coal mining and gas and oil. And we don't want to go there. And then we don't invest in things that rely on creating or reinforcing an addictive pattern of behavior. So that might be, we wouldn't invest, for instance, in a stock picking app or a sports gambling app or a social media app or a game. That's about morals and ethics. There's certainly money to be made there, but it's not the kind of money that we want to make. We focus on what's called pre-seed investment in startups. So we're typically investing in companies in their first external investment round. At the moment, around about a $3 to $5 million money valuation, and we're typically investing a couple of $100,000 at a time. And that money comes from a syndicate. So at the moment, we have a little bit more than 200 angel investors in our syndicate. Most of those people have day jobs doing other things, but they're interested in startups. They want to be part of that journey. They want to learn about these companies and how you build a startup. And they've been able to put aside a little bit of money to invest in some of the startups that we find. We make the syndicate free to join, and we don't charge an annual membership fee. And we try and keep the minimum commitment to invest in one of the companies that we find down around $5,000 at a time. That's designed to democratize who gets to invest in startups with us. So rather than being a small group of wealthy old white men, where we're trying to make us as available as possible. So a lot of our angel syndicate members are actually professionals working in the startup industry itself. They're still holding down a job at another tech company, but they've been able to put aside a couple of grand every now and again to invest in a startup with us. And that's addressing that thing before where I said, well, there was a point in my career as a startup founder when I realized that every startup I did, I was going to have to wait 3 to 5 years to see if it was going to work out. And that meant if I was successful 1 in 20 times, I might not be successful again until I was 70. If you're able to start investing in other startups at an early stage, you're starting to build a bit of a portfolio approach to your startup career. And you may not be an employee or a founder of something that goes on to be successful, but maybe you've made a very early stage investment in another startup that gets very successful, and that might be a life-changing financial event for you. So we last year did about 1 investment a month, deployed about $2 million in capital. And this year, at the moment, we're moving a bit more slowly than that. We think there's no need to rush while everybody's a bit panicked about what's going on in the broader macroeconomic situation. So we'll probably do about a deal every 2 to 3 months for the time being and see how we go.
Yeah. And in terms of the sorts of founders that you've seen, firstly, are there any founders you've ever seen along the way over the journey where you could just tell they were going to be successful because of the personality of the person and their capabilities? And more broadly, what are the traits you look for in a founder?
I think it's very natural to rely on pattern matching in investing. This looks like an investment I've seen before that succeeded for me. I'll invest in. This person seems like a person that led a company that I invested before and that worked well. I'll do that again. And I think whether it's implicit or explicit, whether it's conscious or subconscious, I think there's an awful lot of that goes on in venture capital. I don't think that's always very healthy. We talk about how the startup industry has a real diversity problem. It's mostly white guys, pure and simple. And that's across all professions in startups. It doesn't matter whether you're a designer or a web developer or a backend engineer or a salesperson or COO or people in culture, you're way more likely to be white and male and cisgendered. And if we're designing products and services for the whole world to use, it's much, much harder to do that if we're actually a monoculture ourselves. One of the forces at play there is this pattern matching, where in venture capital, you don't have very much time to make a decision and you don't have very much evidence to make a decision as to whether or not we should invest in a company or the people who founded it. And quite often, whether it's consciously or subconsciously, quite often investors are going, you remind me of somebody I invested in and that worked out well, I'll do that again. So it becomes this self-perpetuating, reinforcing, unconscious, subconscious bias. So we try to train ourselves to look a little bit further afield than that. In fact, we have an explicit diversity mandate for our investments where we expect to see a degree of diversity in the founding team, in the leadership team of a startup before we're really very interested in investing. We think that the research data shows pretty conclusively that a more diverse team outperforms a less diverse team, given the same knowledge-based task. So we think we're more likely to get a better return on investment for our investors if we're investing in more diverse companies. It doesn't mean that we just hard pass on every single company that's founded by a couple of young guys who are straight and white, because that's a very common founding story. If you're both going to quit your day jobs and go and do a startup full time, it's a high risk occupation. You wouldn't choose to do that with anybody other than somebody that you really knew and trusted.
Yeah.
We are all more likely to have people like us in our friend group or in our team at work. That's part of the world right now. But we try and find teams who recognize that could become a problem if it's allowed to continue on. When you've got 500 people and they're all heterosexual white men, what happens to your culture then? It's quite likely to get toxic and out of control. You might end up with an Uber or perhaps an early Facebook if you've read some of the stories about what went on there in the early days. That's
what about, Alan, like the personality type traits, though, not so much where people come from, gender or whatever, things like grit, determination, or what sort of traits like that, character traits, you make successful founders? There must be commonalities in some of that, regardless of race, gender, everything to do with that side of things. That's probably more what I was getting at.
Yeah, cool. Most of the value that the startup industry has created comes from challenging norms, comes from challenging accepted truisms. This is the way the world works. This is the way that industry works. This kind of customer is always going to make this decision based on this data. Most of the valuable startups in the world have taken one of those assumptions and stress tested it and said, is that really true? If we change something, would it really happen? And one of my favorite examples would be Airbnb. Like before Airbnb, there's no way I would have rented out in my spare room to a stranger that I found on the internet. And just no way. Yes, if I'm business traveling, I'm going to stay in a hotel because I know I'm going to be safe.
Hitchhiking for properties or something.
Yeah, exactly. So the most valuable startups usually come from challenging accepted norms. Yeah. And I think it's a good idea to practice that mindset. So when I meet a founder who isn't going about things in a traditional way and who has stopped every now and again and gone, actually, is that really true? I know that's how everybody does it, but is that actually the best way to do it? If I see evidence of that way of approaching the way they go around business, that can be very interesting. It's also really important in the early days, startups don't have enough people or enough time or enough resources. And so they often need to lean on a network of other people who can help. That might be people who can introduce you to a large corporate customer at a high level and you'll be able to reach yourself. Or it might be somebody who's had prior experience dealing with exiting a person who hasn't worked out in the team. So that network of people around a startup can really be a force multiplier and really drive it on to success. And so people who are likable is a really big match for me. And that's actually why we're called Make Ventures.
Yeah.
So we don't invest in dickheads, but we also try to invest in people that other people are likely to like, because we're all more likely to go a little bit further and help a little bit harder and try one more time if it didn't work the first time for somebody that we really like. So we think the power of goodness is actually also in the power of the good people that we back.
Yeah, listen, everyone wants to work with people that are good people, that they get along with.
Yeah.
It just makes complete sense. What about in terms of your ability to do what you do? What are your biggest strengths and how have they helped?
Perhaps I like to talk, but my background as a journalist, I think successful journalists almost always have an unhealthy level of curiosity. You can throw them at any issue of the day and they will get way down deep into it much more quickly and much more deeply than most of us. So one of the things that I most love about startup investing is you can come at me with something in fusion energy or something in wind farms or something in pharmacology or something in mental health. And to get across that space, I need to read a bunch of research. I need to interview some experts. I need to speak to some customers. And I'm using my journalism skills that whole time to do that. When we look at some of the most successful Silicon Valley investors, there's a number of them that have come from a background in journalism. We are all unhealthily curious and we like to get down in the weeds and really rapidly get a solid comprehension of what's going on in a particular specialist space. The other thing which I think is really important is that journalists are all trained to be really good at asking a series of directed questions in order to get to truth. So startup founders, anybody seeking investment for their company is always portraying the best possible version of that company to the potential investor. And it's not untrue, but it's the best possible version and it's more based on a true story than the literal truth.
Yeah.
And you'll see this all the time. If you watch current affairs journalism, you'll see a hardworking journalist trying to get the truth out of a politician, say, or out of the CEO of a corporation. And politicians and corporate CEOs are trained to keep evading that line of questioning and keep portraying the organization in the best possible light. It's the journalist's job to try and pin them down and get to that. So there's quite a lot in common between the journalist chasing the politician and getting the truth, and a startup investor chasing the founder to try and get to the truth of what's going on in their business as well. When we invest in that company, of course, that's only the beginning. If that relationship goes well, hopefully we'll be able to follow on, invest in that company a couple more times. And so it's not like after we've written a check into the company, we just stop trying to find the truth about what's going on in the business. So it's an ongoing relationship, and hopefully with trust over time, they get to become more open and be more comfortable sharing what's really going on in the organization. And that gives us an opportunity to lean in and help and say, hey, here's my mate Dion. He's got really relevant experience in this area. Here's my friend Sharon, who's got really helpful customer contacts for you. So when we work together, we can change. But first we have to get to a point of truth and trust. And our journalism skills come in really handy there.
Yeah, I like that. What about weaknesses, Alan? What sort of things did you struggle with that you've had to overcome, and how did you do it? Or did you do it?
Well, everybody remembers, everybody remembers dyslexia from school, right? And dyslexia, the letters jumble around in your head, and it makes it very difficult to read, very difficult to write, which you've learned. I have something related to that, but it affects numbers instead of letters. And the technical term is dyspraxia or dyscalculia. So for me, 2s and 5s, 6s and 9s, you can tell me your mobile phone number and I will have lost the last 3 digits while I'm typing in the first 4. Really struggle to retain numbers. Starting with basic electronic calculators in senior years of high school, I've gradually been able to use more and more sophisticated technology aids to help me moderate the disability that I have. But I still can't really glance at a spreadsheet and just go, oh, there's something wrong here, like many of my friends and colleagues can. So it's best for me to be partnered with somebody who's got that real instinctive sense of something doesn't look quite right here. But my ventures, that's my awesome venture partner, Emily, as a software engineer. The software engineer has zero tolerance for mistakes. That's where bugs come from. And she's the one that helps me understand what the numbers mean.
Yeah, that's an interesting issue to have to deal with, because like you say, everyone knows the dyslexia part, but not everyone understands that it goes into other things. We had a bit of experience. One of our kids had that or has that, and it's an adventure, right? In terms of, I remember I taught lots of people mathematics and like brothers and sisters, and when I was younger, and my own kids. And then there was this one that I just didn't matter what I did, they were like, they didn't look at it the same way. And I was like, what was going on here? And it's different. And so you've got to adapt, that's for sure.
Yeah, I can memorize the formula and I can apply them. But if I get the wrong answer, I won't see it as the wrong answer. You look at it right away and go, no, hang on, that doesn't look right. And you'll go through it again. And I'll just go, that's the answer. I cannot tell.
Yeah, that's really interesting. But in terms of people within business that you met over the years, or not, or seen from afar, that you respect or admire the way they go about it, are there any people that come to mind?
Yeah, there would be a few. One of the most significant people in my career, I talked before briefly about how I worked for Microsoft. Microsoft in Australia, when I joined, the country managing director was a guy by the name of Daniel Petrie. And he's made quite a name for himself over the years, but he's always been really quite a humble and thoughtful and intellectual person who has never been quick to rush in and make a claim or make a decision until he's really had a chance to review what he thinks really going on. So he's always sought the counsel of others.
We had Daniel on the podcast last year sometime. Yeah. Great guy, and can see exactly what you're talking about. Yes.
Yeah. So when he left Microsoft, he went on to start a venture fund called Netis, which was arguably the first digital media venture fund in Australia. And then after that, of course, he was one of the co-founders with Craig Blair of Airtree Ventures, arguably one of the two most successful venture funds in Australia. And now he's focusing on philanthropy, but not just going out and supporting good causes, but also encouraging the rest of us to support good causes too. So I've had a couple of conversations with him and his team this year about the importance of philanthropy, how I try and, up until this point, how I've been philanthropic is because I rely on very unpredictable investment returns from early stage startup investments. It's been difficult for me to get into a regular habit of giving, but what I do is when I get to the end of a financial year, and I'm relatively confident of how much I've earned in that year, I take a percentage of my income for that year and I donate it to a few charities that I support. But Daniel and his organization are helping me understand how I can set up a philanthropic foundation or become part of another one and provide some more rigor and investment thesis, just like I have in the Angel Investment Syndicate, and really try and professionalize some of this so that the dollars that I give to charity have more impact. That would be great.
Yeah. What about in terms of books and anything that you'd recommend in business or in general?
Yeah, definitely. I'm a big fan of the field of behavioral economics. Behavioral economics is, classic economics is what should happen in economic systems. And then behavioral economics is what happens when we throw people into the mix, because humans are highly irrational. We behave with emotions much more likely than with logic. And so one of my favorite behavioral economics, and so it helps me in investing in startups, because startups are selling to humans and organizations that are run by humans. So I can often, I think, predict what might happen when you take a technology product to market. There's an author in behavioral economics called Dan Ariely, Ariely, and he's the author of one of my favorite books ever, something called Predictably Irrational. And he has a whole book full of really simple hands-on experiments where he shows you how irrational we all can be in our purchasing decisions and how we relate to money and to time and to value. Another favorite book of mine, and again, this one also relates to investing in a way, is a book by the awesome author Annie Duke. Annie was a very successful professional poker player for many years before she started consulting and became an author. her best book, I think, is one called Thinking in Bets, which
Yep.
has lots of really helpful lessons there for people who are investment professionals and personal investors. One of my favorite there is she focuses a lot on cognitive biases, and one of my favorites there is the outcome bias, where you evaluate the decision that you made on an investment according to how successful the outcome was.
Yeah.
When often it's external forces that determine whether or not the investment was successful. It's not your fault that you bought Tesla 3 months ago. Like, that was a perfectly valid bet to make. You shouldn't look back at that and go, oh
Yeah.
no, I made the wrong decision, because nobody could have predicted what's happened in the last 2 months. And then one, I'm just going to plug a friend's book if I can. So my friend Rowan Simpson, is a New Zealand startup entrepreneur. This is his first book. I've been a huge fan of his writing and his blog for many years. So How to Be Wrong is all about helping people who are interested in becoming startup founders avoid the kinds of mistakes that Rowan and I first made when we got started.
Okay,
so
that's a good one.
I'm sure, in all good bookshops. How to Be Wrong.
Huh.
Yeah, Rowan.
Yeah, we'll make sure that's noted in there for sure. But what about in terms of philosophy, in terms of life? Any quotes, or whether it's business, life in general, that you live by or really?
Yeah, my mother's side, I come from a clan of Scots. And my grandmother, everybody in Scotland calls their grandmother Mum. And my grandmother was Mum Hunter. And I often confide in her my hopes and dreams. And I'd often ask her whether she thought it was a good idea for me to pursue them. When I was about 8 years old, I think I wanted to be a long distance truck driver when I grew up. And there was a period when I was about 10 or 12 where I wanted to be in the army. And then later on, I got better at predicting what I might try to do. Anyway, I went off and said to her and asked her, excuse me, do you think that's a good idea? And Mum Hunter would say to me, son, you'll be a long time dead, she'd say to me. And what she meant by you'll be a long time dead was, if you don't try it and you never get to experience it, you've got the rest of your life to wonder what might have happened if you'd done it. So most of the big career decisions that I made that turned out to be successful looked very unlikely when I took them. Sometimes I was forced into jumping onto that log and away from the one that I was standing on because my log was sinking. Sometimes I didn't feel like I had any choice, and I had to take that risk and take that job opportunity or start that new business. But other times it was entirely up to me. And none of the really big inflection points in my career looked like very good bets when I took them. But I remembered her advice, and I thought, if I don't at least try, it took many years to look back on that and wonder what might have happened if I hadn't tried.
When you say didn't look like very good bets, they must have looked good to you, even though you had doubts or weren't sure. They still must have had something that you presumably weren't jumping onto opportunities that you thought were a bad idea. So there must have been something there that attracted you to those opportunities, rather than it was more about taking the leap, right?
Yeah, they were usually interesting and exciting, but I can't think of a time. Yeah. My girlfriend at the time, my friends at the time, my colleagues wherever I was working at the time would have gone, no, mate, no, that's a terrible idea. I don't know if I'd do that if I was in your position. So it was something that would interest me, that would be exciting to me, but it never really felt like it was really going to work. That I would try it for a while and then it would all fall over. If I was going for a job somewhere, it would be, I'll give it a go. And if they're stupid enough to hire me, I'll do my best, but I won't be surprised if I get there, because that's a bit of a stretch. What I'd be expected to do. Or if I start this business, I don't know anybody who's done this before. I'll be making it up as I go along, but I don't have anything better to do, or I'm just really excited about this and I'll give it a go. I started a record label at one point at the dawn of streaming music, when there was the Real Network and Apple launched the iTunes Store. I had some friends who had been modestly successful on a big music label, and the big music label dropped them. And I ended up going, okay, I'm really interested in online music and what the future of that is. And you guys tell me it'll cost about 30 grand more to finish this album and get it out into stores. Let's have a go. So for me, it was 80% learning about how the future of music is going to work on the internet, and 20% helping my friends, and almost no expectation of this being a viable, much less a profitable business. But it was a wild and crazy ride for 5 years. I tell people I was a music label boss. Pretty fun.
Pretty cool. You don't strike me as the sort of person who is motivated by the desire to build $1 billion business for the sake of it. And
Not remote.
I, in fact, know that you're not motivated by those things. But tell me a little bit more about what motivates you when you look at those sorts of opportunities and those sorts of things. It's not the money.
So a lot of the time it's my curiosity.
Yeah.
And then the rest of the time, usually it's an opportunity to make the world a little bit better in some way or another. So in that case, I was helping out some friends who I thought deserved to have their music find a bigger fan base, and that they should be able to make a living out of being the talented musicians that they were. And then once I got them on, then I started signing other artists as well. And every single time it was, wow, this is a really talented person who hasn't found their following yet. Maybe I can help them find their following and succeed. And it's usually the same with startups as well. It usually starts with curiosity around what they're doing. And then I find that I really like the people themselves, and I would like for them to have a journey which is successful. And then I think about the positive change that they're making in the world, and then have to get on board. A recent investment is a startup called Elita Genetics, ELITA. And they're in the business of creating Australia's first stem cell bank for veterinary science. Stem cell therapy is very promising. The research shows it's great efficacy in human medicine around osteoarthritis in joints and stomach issues and eye problems. So there's great future potential in health, but in human health, we have to go through a lot of many decades of clinical trial before that's widely accepted therapy. In veterinary science, the barrier is quite a bit lower. And at the same time, our pets don't live anywhere near as long as we do. So that beloved golden retriever puppy you bring home from the breeder is very likely to suffer from early onset hip and knee problems fairly early in their life. Pugs and other breeds are going to have problems with their eyes, with the digestion. And that's going to start happening around about the age of 5, maybe. And by the time they're 8 or 10 years old, they may be living in pain. They may not be living the best lives. And so stem cell therapy shows real potential for animal health as well as human health. So Elita Genetics starts off when you're a new kitten or a new puppy is very young. On your first vet checkup, you go in, the vet says, hey, we've got this service. We can take a small sample of your little kitten or puppy's stem cells and bank that in liquid nitrogen until later in life they need that. And then those cells can be cloned and used to treat the degenerative diseases that our pets largely die from. Improve the quality of life, extend their life, and make us much happier and feel like we've done something for our pet.
Yeah, right. What's the future hold for you and the business? What's the next sort of 5 and 10 years look like from where you'd like to take it?
Like most startup ventures, if you try and plan it out too far, you'll never get around to starting. We had no idea where we'd be a year after we started Made Ventures, and we're coming up on that. That'll be towards the end of this month will be our first anniversary. I would like to think that we'll be able to recruit more new angel investors and existing angel investors to our syndicate. We didn't know how fast it would grow. It's awesome. We have 200 people in it now. We're delivering some education to them. So we're asking experienced angel investors to come in and teach them some of the basics of investing in startups and being an angel investor, which is really rewarding and fun as well. So I think probably for the next couple of years, we'll probably grow the syndicate a bit each year, maybe increase the number of investments we do and also our average size of investment. And then maybe somebody will trust us and know us and like us well enough to perhaps invest in an actual venture fund with us as well.
Yeah.
And then, most venture funds run for 10 years typically. And at the end of the 10 years, you try and exit out of all your positions in all those companies and return investors their investment returns. And that would probably take me up to about 75. So I think I'd probably be ready to take on some full-time philanthropy like my mentor, Daniel Petrie.
Yeah. Alan, thanks very much for sharing your story. It's been fascinating. So
thanks so much for having me on, Dion. I really enjoyed it.